What most people know about Ares is that you are enormous players in the private credit industry. Private credit, however, is no longer a cottage industry like it once was. Right. There is an awful lot of capital trying to originate loans. How competitive is it today?
It's gotten more competitive, obviously, over the years. When you think about why private credit is growing, you have a confluence of big demand for credit coming from middle market companies across the globe. You have a growing private equity business, which is driving demand for leveraged loans. And you have an increased institutional investor appetite for the asset class itself, given the fact that it's floating rate, senior secured, short duration, and really not correlated to other fixed income instruments that they can buy. From a market standpoint, it's more competitive because the markets are healthy. The economy is doing extremely well. Rates are still low by historical standards, and so I still think we have room to run.
It's competitive. I'm getting to that point about room to run. It is competitive. BDCs, in addition to that, can be 2 times levered now as opposed to 1 times levered. You know, I don't need to tell you, because you've seen this movie before, bad things tend to happen, right, when there's too much money available. Underwriting standards deteriorate, people begin to behave in an undisciplined fashion. Are we there yet?
I don't think we're there yet. We are late cycle, but we're not at the end of the cycle. And I'd encourage people to think about the credit markets on a relative basis. So while we have seen some structural weakening, it's underpinned with really good fundamental economic performance and a lot of liquidity in the markets, which supports asset prices and growth. So I think you have to be cautious when you're late cycle, but the default environment's still very, very benign, and the supply-demand balance is still in check.
So it's still a time where credit market investors can think about a return on capital as opposed to having to worry about a return of
Absolutely.
capital?
And I think the manager matters. At the end of the day, this is an investment asset class where you have to back managers who are cycle tested and know how to navigate late cycle.
On credits that you're underwriting today, are yields or terms easier or lower than they were, say, a year ago or 2 years ago?
From the borrower's perspective?
Yes.
Yes, they are, absolutely. Obviously,
how much?
It depends. Right now, we've seen about 100 basis point tightening in spreads in our core middle market products over the last 12 months. There are some structural challenges in documents that have made it more borrower friendly. So absolutely the markets have become more borrower friendly over the last 12 months.
How much longer can that continue?
Well, when you look at the economy that is still growing, you know, we saw 2.3% print last quarter. We have stimulus from tax reform. We still have central bank support in Europe and in the US. I think we still have a ways to go.
How exposed is Ares to rising rates?
Rising rates is actually a good thing for Ares. So about 75% of the credit that we extend in the private markets is floating rate, and we tend to borrow with longer dated fixed rate debt. So when you look at things like our BDC, Ares Capital Corporation, and some of our private funds, they're all positioned to benefit when rates rise.
How well do you think more broadly the credit market handles the rising rate environment?
Look, I think when you, as somebody who's been in the credit markets for 25 years, you have to get the asset piece right and the liability piece right. And a lot of times you have very good stock pickers or credit pickers who fund themselves inappropriately. We saw that in 2008, and we're beginning to see people make those kinds of mistakes again.
Josh Friedman, whom I know you know well from Canyon Partners, was here 90 minutes ago talking about the concerns he has over the asset liability mismatch in parts of the credit market. It's no longer a bank issue. That was what got us into trouble in 2008.
For sure.
But he says it's in 40 Act funds, for example, and some private vehicles.
When you fund long-term assets with short-term liabilities in the wholesale funding markets, that's a recipe for volatility and potential loss. You see it in parts of the ABS market, you see it in parts of the structured credit market, you do see it in some of the ETF structures. So I'd agree with Josh.
Do you worry about it?
I worry about it for others. We actually don't run our business that way.
I mean, in terms of...
Structurally, yes. I do think that there's some structural insecurities as a result of those funding structures. Absolutely.
And what ultimately causes the rubber to hit the road there?
Well, each cycle is different, right? You never know how it will come. Typically where you see it is you have a liquidity issue that arises in a daily liquidity fund. So if you look at the high yield market and the loan market, close to 17% of those markets are now in daily liquidity funds. So it's very easy to see how outflows in those markets happening quickly could accelerate.
Disorderly sell-off, in other words. As you know, a number of alternative investment managers are taking steps to diversify their capital base. and also to extend the duration of their capital. They're tapping into the high net worth market, they're tapping into the retail market. In some cases, they're doing it through insurance companies, or they're beginning to structure perpetual capital vehicles. How important a trend is that?
It's a critical importance. So Ares today, about 40% of our business is in permanent capital vehicles, and that continues to be a growth area for us. I think it's important for us as managers to be able to navigate a cycle with long duration capital and really identify the best risk-adjusted return. But we're also seeing that our investors now appreciate the value of illiquidity and recognize that with longer duration, they can actually drive higher return.
Because they can afford to wait.
Absolutely.
Don't find yourself in a situation where you're
not
forced to
that
sell.
forced seller. You're the one who's on the other side of that trade buying when the market is showing.
So doesn't that tend to mitigate the concerns, though, over the asset liability mismatch? Because so many firms are trying to do that. They're trying to create drawdown vehicles. They're trying to create perpetual or permanent capital vehicles.
That's why I said for folks like Ares, that volatility potential is a big opportunity because of the structure of the funds that we manage. The long duration and the lack of daily liquidity and mark to market positions us to take advantage of that liquidity when it comes.
I mentioned people know Ares for credit. Some also recognize that you're a relatively significant player in private equity, not just on the financing side, but as an equity investor. How would you describe conditions in private equity right now?
Well, Ares is a little bit unique in the sense that our private equity strategies are global. We have large distressed for control pockets. We have industry funds. We have a business in China. So we're diversified, which allows us to compete in today's market. As someone who lends a lot of capital to other buyout firms, the market is very, very competitive. Significant amount of capital in the market, elevated purchase prices, a lot of competition, underwriting standards have weakened a little bit. So I think for someone who's not differentiated in their approach, can actually add operational value to a company they buy, is going to have a really tough time in this market.
Is it better to be a buyer? Given what you've said, is it better to be a buyer or is it better to be a lender?
I think on a relative basis, you're getting better relative value in most cases lending to a buyout than investing in the equity. The challenge there is obviously your upside is limited. But if you look at what I think the indexed returns will be for leveraged buyout debt versus leveraged buyout equity for this vintage, I would say debt.
Debt. How interesting. Yeah. We've seen a lot of M&A over the past couple of days.
Incredible.
It's an unbelievable amount. Yeah. There's the logistics deal. There's obviously the T-Mobile deal for Sprint, which is a question mark.
So a nice energy
deal for
energy
Asda.
Print today for Endeavor.
The Marathon deal, absolutely. All of these are strategic deals.
Yep.
There is a dearth of large, big-ticket buyouts. Mm-hmm. Is that simply because valuations are too high and it's impossible for the private equity firm, let's say, to buy to create value out of a transaction?
I don't want
like
to say
that?
impossible. I do think you're highlighting that the strategic bid is very strong right now. Corporate balance sheets are healthy at this stage in the cycle. People are going to look to drive value through M&A. So it's not as much that they can't drive the value as much as it's the strategic buyer able to come in and really pay a premium price.
Mike, rightly or wrongly, people look at the alternative investment universe and compare firms against one another, not just as competitors for the same deals, but as investments in and of themselves. How do you distinguish, or how will you distinguish Ares from the firms to which it most often draws comparisons as a large alternative credit investor? Apollo, for example, or Oaktree.
Well, the good news is we're all publicly traded now, and so there's a lot of transparency into the business model and the growth opportunity. The big differentiator for Ares is our management fee-centric business model. So if you look at our focus on credit and the diversification of our business, 80 to 90% of our revenue is actually coming through management fee. So we have a diversity and stability of revenue that some of our alt peers don't have. And when you look at where we are in our growth cycle, even though we're at 106 billion, we're demonstrating 20% year-over-year growth pretty consistently. So we do offer a unique combination of growth and stability. But look, all the publicly traded alt managers, I think, are phenomenal companies, and frankly, most, if not all, are undervalued and a little bit misunderstood.